So there's often been this debate around, are betting markets efficient? Is there a way that you can actually overcome those inbuilt biases to make an endless stream of profits over an infinite number of years? And by and large, you would have to agree that generally they are, because most academic studies that you see on betting markets seem to indicate that the markets are efficient. I've probably read them all. And you also have the same sort of scenario within financial markets. However, there's a problem with that, because if you can beat them over a large number of years, then the markets cannot be efficient. And this is the key point that I want to discuss in this video. If you're interested in Betfair trading and you want to learn how to trade, then visit the Academy where you can do exactly that. If you want to talk to professional Betfair traders, then why not head over to our forum where you can talk to like-minded people, but you can also download additional content. And don't forget to head over to our website to download a copy of BetAngel, the cutting-edge software that will completely transform your trading. So the first thing we're going to look at really here is value betting. And value betting is a case of looking at odds within any particular market, it could be any sport, and saying, well, you know what, I think those odds are wrong, and therefore I'm going to bet against that. Now, in traditional terms, you would just sort of put a bet in with a bookmaker or sportsbook or something, and that would be it. But of course, betting exchanges allow you to bet at any period before that event actually starts, even in play if you want to do that. But also you can sort of decide whether you want to get involved at that price or not. You're not obliged to take the price that is on offer. So, you know, there's a first hint as to how you can get value out of these particular markets. But where I started was by creating statistical models. So I would price up a football match, or I'd price up a tennis match, or I'd price up a financial market. And that would allow me to identify specifically what the odds should be and where the market was. And if I couldn't explain the difference between the two, then there was probably a value bet there. One of the advantages of doing this is that you can anticipate that something will get driven into a value territory, and you can look at the price, you can anticipate that something's about to happen, and then you can back and lay on an exchange to take advantage of that. But the thing that sort of really made the penny drop for me when I was looking at value betting was when I was looking at a horse race at Goodwood. It was a group race, it was a two-runner race, there are only two horses in it. They both won over the same course and distance. They were equally rated. There was really nothing to separate them, and they should have effectively had exactly the same set of odds within the market. And when you looked at that market, that's where they originally started, but in the last 5-10 minutes before the start of the race, their odds diverged dramatically. One of them drifted out to 3, odds of 3, and the other one came into odds of 1.5. In aggregate, the market was perfectly balanced because, of course, you know, one of those two horses was going to win the race. So if you look at it from a purely statistical perspective and from a very broad base, you realize that the market has to be perfect, because if one is too short, the other one counteracts it. And if you add up all those races and all those runners over a long period of time, you can actually identify that the market was perfect from a statistical perspective. But on this particular race, the price on one plunged to 1.5, the price on the other shot out to 3, and yet these horses were equally rated. They were in a group race, they'd won over the same course and distance, there was nothing to separate them. And at that point I was sort of thinking, well, that's weird. There's obviously something else driving this particular market, because I can't see any reason whatsoever that the price on these horses is so different, given the fact that there's nothing to separate them statistically. And what you tend to see in a horse race, and you do see this in other sports as well, is there's a bit of emotion and opinion going on there, and there could be other factors that's moving the price. But in terms of looking at it from a broad basis, the market would be perfectly efficient. In your spreadsheet of the last 20 years worth of data, you won't be able to see that, because ultimately it would have all balanced itself out, and for every horse that had come in a dramatic amount, another price had gone out, and the two cancel each other out. But looking at this race on a very individualistic basis, it was obvious that the horse that had drifted out to 3s had roughly the same chance of the horse that had shortened dramatically, and therefore there was a lot of value created there. And in fact, on this particular race, the horse that drifted dramatically and went off at a much bigger price actually went on to win. So when you're looking at value from a broad basis, it's quite easy to be able to look at the statistics and say, well, you know what, this is very efficient. But on a narrow basis and looking at individual selections within a market, especially over different time periods, you'll get a completely different answer. So what about trading? Is there some sort of an analogy or an example I can give you here that indicates why value can be created when trading? And the good news is there is, because this was something that I cottoned onto fairly early on. Because when you're looking at a betting market and you see all of the movement within the market and you're assessing it from a trading perspective, you can begin to assess it from a value perspective as well, or vice versa. You know, if you think that the price on something is significantly short or too long, then the corrective tends to set in over a period of time. I can give you an example of this, for example. So I have priced football matches for a long period of time, and there was an example earlier in the season where I said, well, you know, Southampton look to be the wrong price, basically. And, you know, not speaking from my pocket or from loyalty, but every statistic I've cut doesn't seem to stack up here. And then gradually we would see the market correct. So it created value at that particular point in time, but I could also trade it as well and profit from that change in movement. But if you want to know where profit comes from when you're trading and why the market appears to be efficient, but it actually is not, get a piece of string, stretch that string out. And if you hold it and you tilt it in one direction or another, you could easily argue that at the start point of that string, which is the market, or the end point of that string, the market will be efficient because over here, the market didn't have some information, over here it did, and that price movement, the gradient on that piece of string that you're holding up, will basically indicate to you, and it could be flat indeed, that the market was efficient at all points between that. But more specifically, when the market opened and there wasn't information in, and to where the market closed and there was information, necessarily that price movement reflects that value of information within the market. But that's not how you trade. When you're trading, think about the string as a wibbly wobbly curve that meanders its way from one point to the other. And in fact, if you flex your string and you put curves within it, then one of the factors that you will figure out if you grab a piece of string, go and grab one now after this video, is that if you actually curve the piece of string and it follows a meandering path from one point to the other, you're actually looking in aggregate, if you pull that string out, at a much, much longer piece of string. And the difference between the length of the string on a market that meanders and one that goes from point A to point B is basically where value is being created from a trading perspective. And your role as a trader is to basically get some of that value. You're looking for uncertainty, you're looking for a difference of opinion, and as long as you have one within a trading market, you'll definitely be able to make money. So that's the theory. And when you present it, it sort of makes perfect sense. But also, that each one of the points that I've just made could attract a fair level of criticism. Why is that? Well, I've basically summarized my knowledge over 20 years, many more, if you want to include the work prior to what I've done here, to try and present you with some simple facts about the way that the market works and my view on the market and why you can have markets that are efficient but seemingly inefficient at exactly the same time. And therefore, you know, I have to crunch that down into a very short video. And therefore, you could quite easily pick holes in all of that. So if you want to destroy any of those arguments, feel free to do so. Because there's one defining characteristic that proves that these propositions are actually correct. And that is that I've actually done it. So I've been sat here for many years now, pumping as much money as I can through the markets, to exploit all of these inefficiencies. The limit within the markets is basically the liquidity within the market. The problem that you have if you start using larger amounts is you begin to influence the outcome of those particular bets or those particular trades, because you then have to start taking prices, and then that destroys the value that you can see within the market. So there's a limit to what I can do within the market, but to all intents and purposes, I've just done the same sort of things over a very, very long period of time. And there seems to be a very large number of opportunities within the market. So putting all of the arguments aside and all of the little holes that you can pick within them, what I'm trying to do here is summarize and tell you where I see the value within the market and the sort of thing that you should necessarily be looking for. Because it's something that I've done now for over 2 decades. Doing it in 1 year you could probably be lucky. You could probably be lucky over 2 or 3 years, or maybe even a slightly longer time period. You could just be a convenient survivor within the market. But over 20 years, do you think that that's possible? That, or do you think that maybe what I've just told you there is actually true? Do you think there is actually the ability to pick off some of these things? For me, it's just a question of framing it. I can prove that the markets are beautifully efficient. I can also prove that the markets are inefficient because for a long period of time I've been exploiting those inefficiencies to make money. And ultimately, I think that's the proof in the pudding. So when I first started doing this, I was worried that I would lose my edge very quickly. I had statistical models. Those models would identify opportunities for me, and then I would bet or trade against those particular models. So I just sort of went for it, basically, traded as many markets as I could and as much volume, and didn't go on holiday and visit friends or anything because I feared that I only had a small window of opportunity in the market. So you can imagine my surprise all these years later that I am still here. And it's mental, really. But I figured out that, in fact, it is mental, because part of the reason that you can exist in the market for a long period of time is if you can have all those models and do all of those things. But if you actually understand how the market works, if you can get inside the way that a market works, that will actually allow you to continue to profit over a long period of time, because some of the structure of the market sort of doesn't make sense. And part of that is because of human behavior. So I've been able to adapt and modify my strategies to exploit that effectively. And that's allowed me to continue over a long period of time. I've got all of those fundamentals in place, but I'm also reached a sense of enlightenment within the market where I can really truly understand exactly the way that it's operating and how to operate within it. But also you tend to find that it's a process of continuous refinement as well. So stuff that I'm working on now, it may change at some point in the future. It could be that the market shifts subtly, or there could be structural changes within the market in terms of the way the markets operate, are legislated, or all of those sort of things. So, you have to work on things that you can control. Things that you can't control, you shouldn't worry about, because there's nothing you can do about it anyway. So most of what I do now is a process of refinement. And, there was a market last year where I saw a decline in liquidity, but I still managed to do better than I did in the previous year. And that was simply because I introduced a few new strategies and that sort of thing. I continued to evolve within that particular market. So despite the fact that the market declined, I still managed to do better than I did in prior years. And this highlights another important factor as well, is you have to have an active involvement within the market. I sort of think I should be taking things a lot easier now and enjoying life a little bit more. But one of the things that you find with the markets is if you're not constantly looking at your data, understanding what's going on with the market and modifying your behavior within it, if you don't do that, then eventually whatever strategy you had 3, 4, 5 years ago will probably fail for one reason or another. You may have to refine and tweak it, or what you're doing and how you're doing it, missing off some things, including others, branching into new markets. It's a process of continuous refinement. The moment you stop doing that is probably the moment that you begin to lose a bit of an edge within the market, even if it's because you're just detached from it from a period of time. But yeah, when I look at the next year ahead, I'm pretty confident that I'm going to be doing just fine. Things will change. I will discover things that I don't know about yet, and other things will begin to drop off the radar. But I know as long as I focus on those core fundamentals, I will have a decent year. And I'm pretty sure that if you focus on those core fundamentals as well, so will you.